Hello, everyone. Good morning to all of you. We have a very interesting webinar planned, for the Saturday morning, and I will set the context. Today, we have a very interesting guest, one of the fund managers, who is quite young, aggressive, and has actually generated consistent returns. And we, PMS AIF World, do very right deep diving of PMS and AIF products across quality, across risk, across consistency. And we, because we have in-depth understanding of this segment, that is where we are able to spot some of the right portfolio managers, and Amit Jeswani is one of them. I would not want to give any detailed description about Amit Jeswani because he doesn't need that. However, I would talk about his philosophy and his strategy in very, I would say, crisp manner. A strategy which has actually beaten all multi-cap strategies hands down in last 3 years, and a strategy which actually maintains beta which is considerably lower than the benchmark. So I would say, it would have a beta of 2/3 of say benchmark. So 72 to 75% is the beta, if compared to the benchmark, and alpha is around 17-18% since inception. And it has been 3 years, that the strategy has been into place. So the one of the factors that I have identified, over these years, that how the strategy has been kind of maintaining low beta and has been delivering alpha is the stock selection, and that too not necessarily going into trying to dive into those waters where maybe you are diving alone. So not basically into the space of small caps, but he maintains a large cap oriented portfolio. So a portfolio which would have around 65 to 70% large cap. So this is actually very I would say strange that a portfolio which has a 65% large cap allocation is still able to generate 17-18% alpha over last 3 years. And last 3 years were not actually very easy years because there was a year 2019 and 20 as well. 2021 has been relatively an easier year, but last 3 year returns actually speak about it. So we thought of having detailed discussion with Amit Jeswani to actually understand, not only his philosophy, but also, the value add that, his philosophy is bringing for the investors. One of the factors which I identified is the actual focus on identifying those businesses which are ideally going to grow their earnings at the best possible rate. So over next 5 years, what are those businesses, which are the ones which are going to grow their business earnings over, by 18 to 25%. If we are able to identify that, then obviously, our risk gets reduced and our conviction, kind of comes, and we are able to build in a very good concentrated portfolio. So that is, I think, the core of Stallion, because Stallion's genesis has been a research firm, because they have been a research firm. And Amit Jeswani, who comes with a very credible, I would say, credentials in terms of his academic background, being a double chartered financial analyst, it supports all this positioning, and we understand that well. That is why we thought of kind of bringing for our clients detailed discussion on finding out what are those businesses which Amit is trying to bet upon over next 5 years, and where he feels that there is going to be a I would say a very decent, and which we have put as number also, 18 to 25% CAGR in earnings growth. First of all, we would want to go through a presentation which Amit has prepared, and then I have a set of questions that I would want to discuss with Amit, and we would keep around 30-35 minutes for the presentation, and remaining maybe 25 minutes for the questions and answers. Over to you, Amit.
Thank you, Kamalji, for a very kind introduction. PMS AIF World has been our partner for a very long time. And the questions which Kamalji asked me, the way he deals with his customers, and when I speak to Kamalji's customers, the depth in which Kamalji and PMS AIF World goes, they are the way they do our due diligence. And I'm very happy that I am in this webinar with Kamalji. I hope I can help you understand where we would be investing for next 5 years, and we together can create value. for each other. So I'll just move to the presentation 1 second. Can you see my presentation? Yeah. So good morning, everyone. Thank you so much for being here on a Saturday morning. I am Amit Jeswani. I'm the founder of Stallion Asset. I'll just move to the next slide. Sorry, I'm using this platform for the first time. Disclaimer, Stallion Asset, as Kamalji said, we are into two kinds of businesses. One's the research desk, which is an old business, and one's the PMS desk, which is the core business right now. We started way back about 3 years, 1 month back, broadly on the PMS platform. We've been a research platform before that. So this document, I would be speaking about some data. The data has neither been approved nor disapproved by SEBI, and SEBI doesn't certify the accuracy of any documents below. So these are, whatever I say, these are just for education purposes. These are not recommendations. So first of all, thank you so much. We just crossed 550 crores. Our goal, as Kamalji pointed out, is to compound your capital at 18 to 25% for next 1 decade. So that has been our goal since inception. We've done better. We've done 35% kind of compounding. But our long-term goal is to compound your capital at 18 to 25%. At 18% compounding, your 1 crore today becomes 5.3 crores. At 26% compounding, your 1 crore today becomes 10 crores. So that's typically the ballpark benchmark that we set for ourselves. Of course, I should warn you, this is not a guarantee, and we will have to go through 2 bear markets at least in the next 10 years. If you invest in an FD today, that should generate a 5%. For next 10 years, that will mean your 1 crore today becomes 1.63 crores. If we invest, let's say, in gold, that should do 8% compounding. That means your 1 crore today becomes 2.16 crores. If we do very well, and if we compound capital at 35%, what we have been doing in the past, then your 1 crore today would be 20 crores in the next 10 years. But that would be a moonshot, I would say. So our goals, very clear goals, set goals. 18 to 25% kind of compounding is what our goals are. Of course, again, this is not a guarantee. Move to the next slide. What have we done since inception? Since inception, our portfolio has compounded at 34.39%. The first year, 2019, when the benchmarks were up 7.66%. That was 2019. If you remember, 2019 was a very tough year for most investors. Our portfolio was up 27.1%. Net of fees. So that is what we were doing. We basically beat the market in 2019 by 20%. Kamalji was very kind. He gave us an award of the best performing fund that year. This year, that is 2020, the last year, the COVID impacted year, in 2020, when the benchmarks were up 16%, our portfolio was up nearly 41%, and in 2020 as well, net of fees, we beat the benchmark by 24%. This year, which is calendar year 21, Kamalji said that this was the easiest year to beat the market, but for me personally, it has been a very tough year to beat the market because our portfolio beta has been very low since inception. So if you saw what stocks were moving higher, the commodity stocks did very well. The PSU banks that did very well. Yet in this kind of year also, we're up 37.76%. Against 27% for the benchmark, and the net of fees, we are beating the markets by 10.59%. This data is till 30th November 2021. So the first question, whenever I speak about my returns, the first important question which majority of my potential investors, customers, partners ask me, that pakka bahut risk liya rahega. That is the first question they ask me, that risk kitna liya hai? What all? You might be having small caps. As Kamalji pointed out, we do not have small caps in the portfolio. In fact, between 65 to 75% of our portfolio is into large cap names. Our portfolio beta since inception against Nifty 50, which is the most popular benchmark, has been 0.76. We've taken 24% lower risk than Nifty 50 to deliver these kind of returns. If you had invested 1 crore in Stallion on inception date, it has become 2.5 crores with lower risk than Nifty. If someone invested 1 crore in Nifty the day we got started, that has become 1 crore 65 lakhs. Basically, Nifty has given 65% returns and cumulative, and we have given 150% cumulative returns to our customers. Now, how do we do this? We typically invest in 4 sectors: consumer, pharma. These are defensives and they help us in bad times. The 2 other sectors are technology and financial. So if any economy has to grow from 3 trillion to 7 trillion in next 10 years, that's what I expect India to go into. The largest wealth creation will happen in technology and financials. But consumer and pharma help us in bad periods of time, because while you can be bullish, there will be times of drawdown also in the Indian stock market. Let's give me an example of 2020, the drawdown months. Now, if we have half defensive and half aggressive, what was our drawdown in the first quarter of 2020? In the first quarter of 2020, where majority of benchmarks were down anywhere between 30% to 35%, our drawdown was 17.5% pre-fees and 18.5% post-fees. So in all 3 years, we broadly performed better than the market. The first year, 2019, was a very narrow market. Not a lot of people did well. We did well. COVID year, we fell less than the benchmark, yet we did very well on the upside as well. We were up 41% in the third year, which is this year where you have high beta, which has done very, very, very well. This year also, we have performed decently well for our customers. So that's the starting point, what we have done in the past. Now let's go, what do we expect in the future? So this is Nifty 500 profit pools. I'm going to keep, there are only 7 slides, 5, 6, 7 slides. I'm going to keep it very short, but I'll tell you how we think about what the next 10 years will look like. So Nifty, the total profit pool of Nifty 500, which is our benchmark, in year 2001, which is 20 years before today, was 38,000 crores. Now this number by 2011, this moved to 3.6 lakh crores, basically a 10x increase in earnings. And you saw the markets also moving higher by this broadly, the similar proportion. Then you had 2011 to 2021 were tough for earnings growth, right? Everyone would complain that there is no earnings growth, and your Nifty 500 profit pools moved from 3.6 lakh crores to 6.6 lakh crores. That is what Nifty 500 profit pools are as of today. Basically, we near doubled in profit pools in last 10 years. So as of today, India's total profit pool is 6.6 lakh crores. I expect that Nifty profit pools will grow at between 10% to 12% for next 1 decade. That means this 6.6 lakh crores of total India profit pool will move to near 17 lakh crores in next 10 years. So that is what we expect. Now, there is an incremental 10 lakh crores of new profit pools to be added. Not every player adds, not everyone gets rich together. That is how markets are. That's how capitalism is. It's those few players who make it very, very, very large in the markets. So the total market cap of Nifty today is 230 lakh crores. Nifty 500 is 230 lakh crores. That means we are trading at 35 times FY21. As I said, let's start with any industry. Let's start with auto ancillary. Okay, the total profit pool. What you want is leaders. Who will lead this entire cycle up? Who will win in this entire profit pool game? If we look at auto ancillary in India, the total profit pool of auto ancillary in India is only 7,000 crores. Out of that, the largest profit pool is with MRF, who is at 1,200 crores. The next most profitable company is Balkrishna Industry, who's at 1,100 crores. Then you have Motherson Sumi at 1,000 crores. These are all sector leaders. MRF is the largest player in tires. You've got Exide, who does 800 crores of profit. Amaraja Battery does about 650 crores of profit. You need to look at who will win this entire game of profit pool. Why do I say auto ancillary is an important sector? Is because there's a large PLI coming in auto ancillary. The total PLI which the government is given is 2.5 lakh crores. Out of that, auto ancillary alone has got a 26,000 crore PLI. Now, who are the guys? 26,000 crores is the PLI, right? Typically, the PLI incentives are 5%. That means the industry will have to do an incremental sales of near 10 lakh crores or 20 lakh crores to get those incentives in next 5 years. That means 4 or 5 lakh crores every year. Who are the guys who will win big? Who are the guys who can export and create very large profit pools here? Would be a very important thing. Like, let's take an example of autos, something that we are not bullish on. In autos, while this number looks 1,300 crores, it's not right, because there was a 13,000 crore impairment in Tata Motors last year, which changed the numbers. So if you look at two-wheeler companies, let's take an example of Bajaj Auto in two-wheeler does 5,000 crores of profit. Hero does 3,000 crores of profit. Hero is the largest in India by market share. Bajaj Finance does 50% exports. Bajaj Auto, does 50% exports to Africa and all these places. Then you have TVS Motor, who does 600 crores of total profit in the auto space, in the two-wheeler space. Then you've got the Eicher Motor, who does 1,500 crores. Now, the total profit pool of two-wheelers in India, 5,000 crores Bajaj Auto, 3,000 crores Hero Honda, 1,500 crores Eicher Motor, and 600 crores TVS Motor. That's broadly the profit pool of India two-wheeler market. You've got Ola Electric coming, and the markets, if you look at the last round at which Ola has raised money, that is $5 billion. That is what, and markets are expecting that electric is the future. And how Ola, and because Ola will also be a hyper pivoter, so the opportunity of Ola will not end at electric scooters only. I'm sure Bhavesh will pivot from electric scooters to electric cars, electric trucks, electric school buses, and all that. So that is what the markets are pricing. The market's pricing growth. So you can't say that Hero Honda is a value buy, because you have to look at value in the sense that what will be the future profit pools of Hero Honda. Can Hero Honda be disrupted? And because the chargers of electric scooters, if you look at the chargers, they're as big as your mobile phone, and they give you 2 chargers. One, you can charge it for 2-3 hours, put it on your scooter, and the other one, you can basically ride your scooter. So that industry is ripe for disruption, and that's why you see the markets doesn't give valuation to your auto, two-wheelers, and everything. So let's focus on the industries that we are very bullish on. So in my humble opinion, the largest profit pool will be created in 4 sectors. That is consumer, finance, technology, and pharma. Now let's start with technology. Technology profits in India. So I'm just here. So the total profit of technology in India, all technology companies combined in India, out of 6.5 lakh crores is 91,000 crores. Out of that, TCS alone is 34,000 crores. Infosys is 20,000 crores. HCL Tech is 11,000 crores. Wipro is 10,000 crores. If you look at markets globally, so 13% of India's total profit pool is today technology companies. If you look at China, the total profit pool from tech companies is near 45%. The total profit pool from US from tech companies is near 50%. They are also 50% of market cap in US. In India, this number is just 13.5%. In my humble opinion, we will also in India move from 13% to at least 30-40% in the next 1 decade. That is where the largest profit pool creation will happen. It will happen in tech services, and it will happen in so TCS is also very small in terms of the global opportunity in IT services around the world. The total IT services markets is $3 trillion. That's the total IT, and TCS does $20-25 billion of revenue. So TCS is also just 1%, and TCS has only 1,800 customers. Infosys has only 1,250 customers. So they are still there's a long way. And out of these customers also, only 20% are cloud enabled. They are saying that the game is just getting started from the pivot from traditional mainframe to the cloud. In my humble opinion, very, very, very large profit opportunity with, pools will get created in and Indian technology on the product side, on the consumer tech side. If you look at all Indian business models, they are copycats, right? Ola is a copycat of Uber. Flipkart was just essentially copying Amazon. If you look at all our business models, Zomato was and Swiggy has just copied Just Eat, so and DoorDash. So we can basically see how the pivots will happen and what is not successful, what is not successful outside India, and see if Indians can execute that. And basically hyperscale into large profit pools. So where goes the profits? With efficiency, that there goes the market cap. So I'll just make one important point here. High ROC, which you get in tech services companies, because these are all asset light companies, their ROCs are infinite. High ROCs means one important thing, that you'll get very low drawdowns. Like HUL has an ROC of 100%. It means that it doesn't mean that you'll grow fast, like your stock price will go up a lot. All it means that you will not have large drawdowns. High growth means your stock price action will basically move with growth. So you need growth to make money and ROC to protect your drawdown. In my humble opinion, tech services, at least for next 3-4 years, 5 years, because that's the topic, will be the new defensives. They will act like consumer companies used to act between 2010 to 2020. Anything going bad, people will move to tech. So tech services, in my humble opinion, will act as defensives, but they will grow as well. They'll grow at very, very decent rates. Your large cap companies like TCS, Infosys will grow at 15%, not a recommendation. And your mid cap companies, because large cap companies will, what they'll do, whatever cash they're generating, they will do buybacks. And or they'll give you dividends. Okay, buybacks make sure the stock price doesn't go down, and dividends also are there. So people will always be attracted to large cap tech. Mid cap tech, if you look at mid cap tech, they are not doing that. Mid cap tech are reinvesting that cash flows to do acquisitions. Persistent lately did an acquisition. Coforge did an acquisition. So that's where the high growth of 25-30% will come. So to everyone to his own, you've got. So in IT as well, you've got mid-cap companies like LTI does 2,000 crores of profits. Coforge this year will end at 700 crores of profit. Tata Elxsi does 500 crores of profit. And you have seen that large wealth can be created in tech services as well. If people who don't see charts so much, just look at the chart of Accenture. Just Google for 1 minute and look at the chart of Accenture. You will see that how globally, tech services just doesn't fall on bad times. Coming to the other side, you've got private banks. Those are that is where we are optimistic on. So if you look at private banks as well, I'm speaking here, the total profit pool of private banks in India is 75,000 crores, dominated by HDFC Bank at 32,000 crores. Then you've got ICICI Bank at closer to 20,000 crores this year. Then you have Axis at 6,000-7,000. Kotak did 10,000 crores this year. So that is how profit pools. IndusInd is at 2,000 crores. Now you have to see any economy which grows, finance has to grow. It's not possible. So one thing is very secular. If you look at GDP to debt, if you look at all developed markets now, debt to GDP is like 200-300%. And you would have seen that debt is growing faster than GDP. Every time you go to any Europe, just Google any European country, you'll see debt to GDP is 200-300%. And when you look at the chart of debt to GDP, it keeps going higher. In financials, you need people who can control and take care of your credit risk, which private banks have displayed time and over again. This time I was surprised looking at SBI bank numbers as well, to be honest. On a 40 lakh crore book, the total credit cost of SBI was 4,000 crores. It just tells you that there is virtually no credit losses which are coming as of today. That's one space where I am very confident that profit pools will increase from. But I'll tell you, a lot of that profit pool will also come with tech-based lenders. If you look at the market cap of Goldman Sachs, which is at $120 billion, Wells Fargo is at $170 billion, Morgan Stanley is at $120 billion. All these are lenders for last 100 years. Bigger than all these is, let's say, a Visa. Visa's market cap is $450 billion. So Visa is just a tech-based network effect platform. Every time you swipe your debit or credit card, Visa gets rich. The largest money in financials as well will be made by tech-based financial companies. Then that's what Bajaj Finance, who made profits of, let's say, 4,500 crores last year, is trying to do. Bajaj Finance is pivoting to 4 apps, and that's why you have a small tech premium to Bajaj Finance, because Bajaj Finance's inception has consistently pivoted from one profit pool to another. It started off as a consumer. It started off as two-wheeler financing, where it used to be the captive arm of financing Pulsar bikes of Bajaj Auto. Then from there, it pivoted to a consumer finance, created a monopoly. From there, it pivoted to housing finance. 2016, they started housing finance. And today, the total book of Bajaj Finance is 1.68 lakh crores. Out of that, 50,000 crores is housing finance. No other guy has been able to hyperscale like Bajaj Finance. So with large opportunity, you also need good execution. Without execution, that opportunity is useless. So coming to the other part, the total profit pool of consumer companies in India is 41,000 crores. Now, even that, the largest player there is HUL, who makes 9,000-10,000 crores. ITC makes 14,000-15,000 crores. Then you have your Nestle, who makes 2,000 crores. You have Britannia, who makes 1,500 crores. You have Godrej Consumer, who makes 1,700 crores. Who do you think will win in this opportunity? That is, the profit pool is going to expand from 6.5 lakh crores to 17 lakh crores. The question is that who is the guy who's executing, who's reinvesting, who's creating moats, monopolies, and scaling? Where you can't make money in bad companies. You have to buy good companies, good businesses to make money. Over time, in every industry, profit pools get dominated by 1-2 players. Now, the profit pool share of consumer companies is 6.3%. For technology companies, is only 6.3% is consumer profit pool in India. For technology companies is 13%, as which I said, which will go to at least 30 to 40%. That I'm very confident on. Private banks is 13%. Pharma, the total profit is 36,000 crores, so near 5%. If you look so I am very confident tech, financial, consumer, these three will lead India's profit pool expansion. So I'll just go to the next slide. This is the key triggers of profit pool expansion. In my humble opinion, the number one policy of the government of India is the PLI scheme. The total PLI scheme is 2.5 lakh crores of India. Let's take an example of the electronic PLI. India's electronic PLI is 40,000 crores, which is largely your mobile phone PLI. So think about it. India's largest import is oil. Second largest import is electronics. Think about it. India's total smartphone market is 1.7 lakh crore. Out of that, the less than 15,000 market, leave the Apples and everyone, that will go to Foxconn. The less than 15,000 category market is 1.2 lakh crore. Out of that 1.2 lakh crore, 5 players have got PLI license. That is Carbon, Lava, Micromax, Optimus, and Dixon. These are the 5 players. Carbon, Lava, Micromax are not in very decent shapes. Who do you think will win this 1.2 lakh crore PLI game in the mobile phone category? The license is out. Dixon, these 5 players are the winners already. Who do you think will hyperscale and win this large opportunity? Dixon revenues as of today is 6,500 crores in FY21. They are market leaders in LED lights. They are market leaders in TVs in India. 35% of all India's television sets are sold by them. So that is how you look at execution. They've been reinvesting capital at 35% ROIC. And if mobile phone becomes dominant, then ROIC should move to 45, 50%. So that's how you look at who are the guys who are going to execute in a large opportunity size. We've got so PLI will be one of the largest, in my humble opinion, the largest, because the incentives are 5%. That means India will have to get the 2.5 lakh crore PLI. You have to do 20 times more sales. That means you have to do 50 lakh crores of additional sales to win this PLI incentives that all companies are going for. Second, if there is one industry which creates the largest profit pool is real estate, because 200 industries are directly and indirectly related to real estate in India. Yesterday, I'll just go back a little. The total profit pool of all building material components in India is 7,100 crores. Which out of that, 3,000 crores is Asian Paint. 700 crores in painting industry is made by Berger Paint. Supreme Industry makes 1,000 crores. Polycab makes 800 crores. Astral makes 500 crores. This year, because of CPVC prices going higher, Finolex also made 700 crores. So you have to basically see how do you play this real estate recovery. It's a 10-year cycle, which is now moving back to. So I'm not saying real estate prices will move higher. I'm saying the velocity of sales will come back to normalized levels. Which now you have 3 ways to play the real estate cycle in next 10 years. So India cannot grow without real estate. That is for sure. Last 1 decade, real estate didn't do well. We didn't do well. 2001 to 2013, real estate did well. The economy did well because 200 industries get connected. You need tiles, you need cement, you need steel, you need paints, you need labor. Those laborers will go out and watch a movie. So everything gets related to your real estate. Real estate is one of the biggest drivers. In my humble opinion, that cycle is moving, which will expand profit pools. Now, there are 3 ways you can play real estate. One is housing finance companies. The spread of housing finance has gone down. That is one risk that you're going to take, because everywhere I go in Bombay, it's like 6.5% Kona Kotak, and all those other bankers who want to give loans at 6.5% to customers. So in housing finance, NBFCs can't compete. In fact, Bajaj Finance's Rajiv Jain also said that in these scenarios, even if we do our best, we cannot make more than 13% ROEs on our housing book, because the rates at which banks are flushed with liquidity and they just don't know where to lend. So if you look at CASA ratios, the CASA ratio of HDFC Bank this quarter was probably the highest at 47%. It typically goes from 39, 42%. This quarter, the highest CASA of HDFC. So there's a lot of liquidity, and these guys, real estate lending in India is typically risk-free. So everyone's going for that profit pool. The third way, and that is how we are playing at Stallion, which is our building. So you can play 3 ways. One is housing finance, which worked very well. You had your Canfin Homes, Grew, Repco, which created a lot of wealth in the last cycle. The second way is real estate builders. The problem in real estate builders is they are very dodgy. Most of them. So we don't touch them. The good guys are a little more expensive than where you would have, and it's very tough to understand P&Ls. Like Godrej Properties, one of the best guys. He's not paid taxes from inception to date. In last 7-8 years of reading Godrej Properties, there was a time that we used to hold Godrej Properties in our portfolio. So I'm just telling you, they would not pay taxes. It's very difficult how the reinvestments are. To understand how reinvestments are happening here. The third, where we are very long, I've written auto ancillary. It's actually building ancillary. My apologies. So you can building materials is monopolies. Think about it. For paints, you have one guy who dominates full profit pool, right? 80% of profit pool is one guy. If you look at let's take an example of wires and cables market. The total wires and cables market is 50,000 crores in India. Out of that, one player, Polycab itself, is 9,000 crores. KEI, who's the second largest player, is 4,000 crores. The third largest player is Havells at 3,000 crores. So there is dominant monopoly. You have to go through them. If you look at structural steel tube pipes, there is one player, APL Apollo, who has 50% market share. If you look at let's say Kajaria in the ceramic space, he's one guy who dominates. There's no number two only. So you get that market leadership. These guys reinvest at 20-25% ROIC, and they will keep reinvesting for a very, very, very long time. So that is what you get. That's what I like about building materials. There will be growth. There'll be high ROIC. There is market leadership, and you for next 3-4 years you can ride it just like how you can ride technology plays. Now, technology I've already covered. So one point I missed to say, I'm near 90% sure that technology will be 40% of India's profit share. If India's profit share in next 10 years is going to be 17 lakh crores, as we said in the first slide, 40% of that is near 7 lakh crores. Today, technology profit pool is 91,000 crores. So there'll be a 5-6x expansion in profit pools in technology. If someone tells you technology stocks are expensive, we'll have to do some other video on technology stocks of how to value technology stocks. That is for something else. But there will be, so in technology services, everything's very clear. In technology product, basically the Zomatos and Nykas and all those new listings of the world, remember one thing, OPEX is CAPEX. Right. So if I do typically in an old school company, if I do 1,000 crore capex, it goes in the PNL. I have to just put 10% as depreciation rate. In a Nykaa kind of business, which has 7 crores as yearly capex, 7 crores was the capex of Nykaa. All the advertisement cost and whatever capex they are doing, that goes in the PNL. Right. So P is no way to, you look at users. How recurring are the users, and for how long this user will give me how much money. I know this is very tough to understand. Like Nykaa has got 71 lakh annual transacting users. Every user buys for 4 times a year. Every time they buy, they pay 1,900 rupees. That means on the beauty segment. So that means every user will do 1,900 into 4. That is 7,600. 7,600 per, my gross margin of Nykaa is 43%. That means Nykaa makes a gross margin of 7,600 into 40, which is closer to 3,000 rupees. Right? On that 3,000, how much is the fulfillment cost? So per customer, Nykaa makes a certain amount every year because these customers use the makeup, and that makeup gets over in 3-4 months, come back again to buy more makeup. That's how you value it. If Zomato is doing, let's say, 15 crore orders this year, this quarter. So Zomato did a GMV of 5,500 crores and 15 crore orders were processed by Zomato this quarter alone. That is closer to 15 crore divided by 90, closer to 13-14 lakh orders every day. Is what Zomato is doing. Zomato on 5,500 crores GMV lost 300 crores. Adjusted loss was 300 crores. That means he needs only 3-4% of higher price to get that entire and move into profitability. Right? That day that J curve happens, you will see very large. So don't just not understand it. Don't go overboard it, but don't not understand it. There will be 2 kinds of investors here. One who understand that these are new businesses. The other ones who will say that, you know what, I'm a value investor. I will not understand new businesses, even though top 10 out of 9 companies in the US are technology companies. I still don't want to understand. All top Chinese companies are technology companies, but I don't want to understand because I don't want to learn. There will be some certain set of investors who will say, you know what, I'll put 5% of my portfolio. Worst case, I'll lose 20%. That means I'll lose 1% alpha. But I want to learn this entire game of hyperscalers of technology. Sharks in an ocean. This is probably one important slide. We want people who are small in the entire market. I have called them hungry sharks in an ocean. These are niche market leaders with a very large opportunity size in front of them. This is very important. Look at execution. because opportunity size is like ecstasy. It is there, but who's going to get that? That we will find it. That is where the execution comes in. And I have seen the ones who execute is the only ones who execute. And that's why you see market gives a very high premium for companies who execute, especially in bad times. If well-fed sharks, as I took an example of Hero Honda, last 5 years, same profit pool of 3,000 crores. Bajaj Auto, same profit pool of 4 to 5,000 crores. That is not where large wealth creation will happen. They are dominant already, but I don't see large profit pools growth happening. The idea is to be, let's say, DMart. It is 25,000 crores revenues. And the total profit pool, the total 25,000 crores is the total revenue of DMart. Right, and people from 600 to 4,700 have been all saying that it's a very expensive stock. We might have vested interest here, but the total retail market in India is 50 lakh crores, right? And the one with the lowest cost always wins. Look at what has happened to US, Walmart. Look at the stock price chart of Costco. He's the lowest price guy. How he's won the entire game. How wealth was created. Look at Aldi. Look at Tesco. So that is where Tesco in UK has 3,900 stores. DMart has 240 stores in India. So a large opportunity is consistently, when you get those kind of investments, you will not get it cheap because we will buy more, right, if it goes down. So it's very difficult to get those kind of stocks very cheap in the traditional sense. So typically we don't want to bet on a Maruti who's already 55% of India's automobile market share. We want to bet on something which is 1, 2, 3% of India's market share. But it is a market leader. Like HDFC in year 2000, it was a market leader, but total book was 10,000 crores. Today, HDFC is the total India's credit book has, in year 2000, the total banking loan book of India was 4 lakh crores and HDFC was 10,000 crores, but it was a market leader that time also. 20 years later, India's loan book has gone from 4 lakh crores to 110 lakh crores. And HDFC is at 10 lakh crores. It is still 9% market share, but it has grown way faster than the banking industry. So you want companies who are small, but once they become like 25-30% of the market, that's where you can't grow way faster than the markets. Small caps are overbought. So we knew that questions will come. That these are my last 1 slide, 2 slide. We knew that this question will come. That what do I think about the markets? I would caution you that this is one of the indicators we look at. This is just a plain monthly RSI indicator. This is nothing big that we look at. So every 4 years, there's been a small cap rally, and then they go off to sleep. It happened in 2021. It happened in year 2017, and then 2018-19 were very painful. It happened in year 2013-14, then 15-16 was a little painful. You had China crisis and whatever. It happened in year 2010, and people who were invested in 2011, 12, 13, they know how painful that drawdown was, because India was called Fragile Five. It happened in 2007, the small cap rally I'm speaking about. So it happened in year 2003-4. It happened in year 1999-2000. It happened in year 1996. It happened in 1992, where Harshad Mehta crisis, Harshad Mehta bull market happened, where Sensex went from 350 in 1989 to 4,500 in 1992. So small caps are now in that overbought zone. All I would say that we are cautious on small caps as of today. There has been a very sharp rally, and we are cautious on small caps. The next slide, the last slide. Strategy going forward. Technology is the new defensives, whereas consumer tech, real estate are the new growth drivers. India will move from a $3 trillion economy to 7 trillion. Profit pools will expand from 6.5 lakh crores to 17 lakh crores. The question that we ask every day, who will make the highest incremental profit of the 10 lakh crores? Markets will be narrow. And whenever markets get narrow, if you remember, for those who are there in 2018-19 will remember Ritik, where only HDFC Bank, Reliance, ICICI Bank and those kind of stocks will move. If someone was there in 2013, 2012, 2011, those will remember that time Eicher Motor, Page Industries, they were hyperscalers, right? Eicher Motor would grow at 40-50% every quarter. Page would grow at 40-50% every quarter. You had Bosch, which was doing very well. You had Ajanta Pharma doing very well. Sun Pharma. Those were the high growth stocks. Lupin, that was doing very well. There is always a bull market in India. There has never been a time that there is not a bull market in India. Wherever there is growth, longevity of growth is perceived by the market and high ROIC, because you cannot grow with, if your growth is higher than ROIC, if your growth is 20%, 30%, and your ROC is 20%, unless you can dilute again and again, that growth cannot sustain. It is mathematically impossible to sustain that growth, because you will have to lever up. That is for someday else. But remember, if growth rate is higher than ROC, it cannot sustain. It will have to revert. If RBL ROE is 10%, ROE of RBL Bank is 10%, it can't grow at 30% unless it keeps diluting. It is not possible. 2021 to 2025, thanks to real estate, will be one of the highest earnings growth years of Indian economy. Enough bottom-up stocks will do well. So if you miss the 20, even if someone invests here for the 2025 bull market top, large wealth will be created. China disruption is probably the largest boom for India, 10x bigger than GST or any other opportunity. Keep your portfolio betas low. We have kept our portfolio beta at 0.83 against Nifty 500, because in India, bullets will come. You don't know what will happen. Demonetization, GST, all these kind of things will happen in India. So if I didn't speak about the last 10 years, but a lot of events will happen in India. You have to always keep your portfolio beta low, because once your portfolio goes down 30, 40, 50%, you have to make incremental 100% to get the same money back. Be low on beta always. We always try to be low on beta. Stay in the game. Do not get out of. Don't say markets are valued, overvalued, undervalued. You have to stay. Think of this as a restaurant kind of business where I'm the manager of your restaurant. At end of every quarter, I come to you and tell you what we have done in the restaurant, what stocks we have bought, what stocks we have sold, and you can of course see your portfolio at end of every day on basically your galla, whatever the restaurant is doing, that you can see at end of every day. So that is how investing is there. Stay in the game, be in the right stocks. And yes, as long as you're doing well, we should do okay. And even when we look at 1 year, 1.5 years from today, we have enough places where there is secular growth, and we are very convinced that we should do okay. But this year, so last year, everyone made alphas, mostly the small cap guys did well because everything was moving higher and they were all on high beta. The next year will be a lot more challenging compared to last year. So thank you so much, Kamalji, for inviting me. If there are any questions, Kamalji, yes, of course, you're the only one who will be asking me questions.
Sure. Amit, so kindly stop the screen share now.
Yeah.
I will ask you.
Yeah.
Right. So it has been really very insightful presentation as it was expected. So now, I would want to ask you a very foremost question that comes to my mind. So you have given, context of last 1 decade, and you mentioned that in last 1 decade, there have been cycles of 4 years. It started from, say, 2014 and then 2017 and then now 2021. These 3 years have been those years where small and mid caps have rallied. Otherwise, obviously, small and mid caps kind of, have given very difficult pain to investors, and that kind of looks like that kind of, we are headed for that pain, as you said that they are overbought. However, you also mentioned that in last 1 decade, because of a lot of sectors of the economy not participating, one, for example, being real estate, which is one of the large sectors, India's economic growth has been coming down. And we also know that, India's GDP growth was down. So last 1 decade was not a high growth year. And that is why maybe, most of the years saw a narrow stock specific rally. Only very few years, which is like 2014, 2017, and then 2021, they saw a broad-based rally. And that is why small and mid-cap participated in those years. But now the reason to invest that investors have on their minds, and that you also acknowledged in your presentation, which is 3 trillion to 7 trillion growth over next 7 years is what we are expecting. So this is a growth phase of economy, which is the reason why we are investing into equities, right? So if that is the era, then in your portfolio, because your portfolio has very large allocation to low beta stocks, to large cap stocks, right? So how will you, kind of generate continuous alpha? So I'll give you another context to explain this, right? What a lot of investors have also seen, and what we also see in the PMS industry, there are large PMS players like ASK, for example, Motilal, for example. If you see their last 1 year returns, they have not been able to generate much alpha because they are very large in their AUMs. You have been able to generate alpha because you are small in your size. But in your portfolio, you are having large cap companies. Now, please understand it from this context. The large cap companies that you're holding in the growth phase of the economy, how will you continue to keep generating alpha over next 5 years?
See, alphas will come if our companies grow faster than the broad economy, if they have higher ROICs than broad economy. So let's take a understanding of where Nifty is. Okay, Nifty is at 35. Nifty 500, as I said, is at 35 P. Everything is benchmarked to Nifty 500. Okay, and Nifty 500 has an ROC of 13% as of today. You're paying 35 P for 13%, assuming, and I said Nifty 500 will grow profit pools at 10%. Now, if I pay higher PE, let's say I pay 45 P, I'm getting 25% growth, and I'm getting a 25% ROIC. It is not that it is still a value stock for me. It is a deep value bet for me, because against the benchmark, if I can double my earnings in 3 years, and benchmark, after 3 years, the P of 45 will automatically come to 22, right? But the benchmark P will go from 35 to, let's say, 25, right? But I will still have higher growth and higher ROIC. Automatically, the markets will readjust me and back to like premium, 30% premium to the market, right? 40%, 50%. That is how our alpha generation will happen if we go right on growth, longevity, and valuations. That's the one thing. When I say valuation, I don't mean to buy 5p or 10p like a paper stock and saying that, you know what, this will go to 15p, I will sell it off because 10p is undervalued, 15p is overvalued. That I'm not telling you. That mean reversion we will not do. We'll buy good companies only. Low beta doesn't mean low growth, right? Let's take our quarter this year. Let's take consumer. We had DMart, which in my humble opinion will grow at 40-45% for next 2-3 years, right? Even something like an Asian Paint, which is a defensive, okay, grew at 35%. Indigo Paint, now Asian Paint revenues is 20,000 crores. He did 7,500 crores of revenue. I'm just giving an example, okay. 7,500 crores of revenues is what Asian Paint did this quarter. On that also, last quarter was positive for Asian Paint. It was negative for Indigo Paint. On that also, Asian Paint grew at 35%. Right? So it's not like, and your Berger Paint grew at 26%. Your Indigo Paint would have 800 crores of revenue. That also grew at 24%. Your Asgo Noble grew at 15%. Your Concern Aerolite grew at 17%. This is paint industry. Look at buyers and cables. You had your Polycab grow at 30%. You had APL Apollo who's guided for after last year. So everything is growing fast. It's not like for small caps. If I have to be in small caps, I will not buy for 20% growth, Kamalji. I want explosive 40, 50, 60, 70% growth like Dixon Tech, which is part of my portfolio. This is not a recommendation. We were the first ones to get it. There was not a lot of people, or at least I don't know many people who were the first one. And now you see everyone saying, no, this is a blue chip. APL Apollo, it's already been a 7x for us in last 1 year, right? We were the first ones to get it, and now everyone's getting it. It's like first we buy a good company, and after this going up 3-4 times, if people are buying it, because they are buying for 20% more returns, right? But we get an advantage in our emerging. So our portfolio is based off emerging portfolios, hungry sharks, and people who are filled, like basically the proven monopolies and emerging monopolies. We have outbeaten everyone in the emerging monopolies portfolio part, where we had stocks like APL, Dixon, which everyone's buying now. I'm not saying they're not buying. It's not like they're doing something wrong. And But we've beaten everyone else on the emerging portfolio monopolies part, and that is why like something like India Mart, which went up 7-8x for us, that was a monopoly, was generating 400 crores of operating cash flow. So those were very easy bets. Something like Naukri, which not a lot of people had. Those were things that made difference. Our emerging so your proven monopolies help you on downside, but your emerging monopolies, those hyperscalers, will help us on the upside. Let's take Nykaa supply will come on the 10th, 11th of December. If there's a supply which is coming, with the anchor book is 40% of the total IPO. The total IPO size was 5,000 crores. That means 2,000 crores is anchor book size. About 1.8 crore shares are coming on the block because they were not allowed to sell. They're going to make 100, because their IPO price is 1,100 rupees. They'll come to sell between 10th and 11th of December. So that is where typically a bottom is made, because you have a new repricing which is discovered. Because if 50 lakh shares come to the market of a 2,000 rupee stock, that's 1,000 crores of supply, right? A new pricing is getting discovered, and then you'll have, and these are not the retail guys who are bidding these stocks. These are all institutional guys who understand everything. Retail will never buy these kinds of stocks. So we shall do well in the emerging this thing basket. But that emerging monopoly has been later bought by everyone, saying that this is proven monopoly, right? It's the journey of an audible.
Yes. No. Yeah.
Sorry.
Right. So yeah.
So if you look at last decade as well, who are the winners of last decade? Look at Avanti Feeds. High growth, used to grow at 40-50%. Astral used to grow from 40-50%. This Astral is, Sandeep Engineer is also a hyper pivoter. He pivots from one profit pool to another profit pool. He started from CPVC pipes, exited Lubrizol style. He then went into adhesives. And adhesives, you will not believe, 4,500 crores is the revenue of Pidilite on adhesive business. This guy from nowhere in 2016, he acquired Resinova. And from there, he's now created a 1,000 crore adhesive business, and nobody even knows about this. And it's a very good business, what he's created. He's the first challenger to Pidilite, because Pidilite always buys out the challenger. That has been Bharat Puri's strategy. Whoever comes to challenge me, that Aralite. Aralite was the only challenger to Pidilite. There also he bought. So now you need those kind of entrepreneurs who can pivot from one TAM to another TAM. And that's where larger wealth will be created. But I don't find any reason why the alphas will not come. But we will keep our betas low. It's not like alpha is the main goal. The goal is to do 18 to 25% compounding. In that case, we have taken 10% as our broad alpha range, which we target. The team is motivated and focused, and we are looking at what works in markets and what doesn't work in market. Our research is not about creating Excel models. It's about what has worked in markets, what is working in Chinese market, what is working in Indonesian market. Let's understand, and who's trying to replicate that. And if promoters are not doing that, we tell promoters, listen, you know what? There's an opportunity out there. We tell promoters, you know what? You're not doing this. See, this guy's doing this. Can you replicate this in India? If you can, then why? So whenever we speak to promoters, we don't ask next quarter what will be the EPS of the company, because we don't care about all that. We want him to get into larger profit pools and create those hyperscaling monopolies. And that's where we and our customers make money.
Right, Amit. Quite insightful. So I understand that the beta being low is not a matter of chance. It is a deliberate decision. Yeah. And that is how you want to, manage, which is, quite clear. At the same time, your portfolio has another uniqueness, as you also highlighted, that you have been early invested in some of these, new age companies. Like you mentioned, India Mart, Info Edge, and lately in your portfolio, there have been stocks bought like Nykaa, Zomato. There are, I would say, very few investors who actually have conviction for these stocks. I will tell you, that there is a poll that I had ran while you were giving a presentation. I had mentioned, 8 companies. They were a mix of old economy stocks and new economy stocks, and stocks like Asian Paints, Bajaj Finance, Divi's Laboratories, Nykaa, Zomato, are the ones that I had, kind of mentioned. And my question was that please kind of pick stock which you think you have the biggest doubt in terms of double-digit earnings over next 5 years. And the stocks that have got maximum kind of votes are Zomato and Nykaa, followed by older economy stocks like Asian Paints and Bajaj Finance. So these are the four stocks. If I want you to kind of cover maybe 2 minutes each on these four stocks, starting from Nykaa to Zomato to Asian Paints to Bajaj Finance, two from new economy and two from old economy, which are, I think, today important stocks in your portfolio also, and audience also wants to know.
So so these are not recommendations, first of all. So you will not even come to know when we come sell these stocks. I'll just first be very upfront about that if you buy these stocks based on my thing, you have to sell when I sell. Because it will be very difficult for me to tell you when I sell. And believe me, in markets, in technology stocks, you don't take 10-year views. You have to take every quarter a view of what next 2-3 years will look like, right? I have been a technology analyst at Guggenheim Partners, and I used to cover global technology for them. I used to see that till the time customers love the product and there is hyperscaling happening of 40, 50, 60% growth, typically the stocks don't come down. Okay, that was my first understanding of growth. But customers need to love a product and it needs to be a monopoly. It cannot not, or a duopoly at best, right? You cannot buy, if you're like, we will not buy, let's say, a Paytm as of today. Okay, we love that Paytm has users, 32 crore users, right? But Paytm doesn't have one large market leader business which generates cash flow. So if you look at all these hyperscalers, there's one thing common. They have one business which generates cash flow that is reinvested in other businesses. Let's take an example of YouTube, who had search as Google, who had search as a cash flow generator. That cash flow was used to build YouTube. Today, YouTube is equal revenue to Netflix without even creating or spending a penny at content cost. Okay. Then he got into Android, Gmail, Gmaps. All these things were from one cash flow. And that is what Naukri also did. If you think about what Bikhchandani ji did, Bikhchandani created one Naukri cash flow. That Naukri cash flow he created 99acre, Jeevan Sathi, Shiksha, Zomato, Policy Bazaar, and now Grey HR, and so many new startups that he's investing in. So you need one mother cash flow machine. That first you have to identify what is that mother cash flow machine which is going to be, and where is the reinvestments going to be. That's how we value stocks. How much cash flows they generate, how much of that they reinvest into ROIC at which they reinvest. Now, coming to stock-wise things, Nykaa. So this is where we might go a little bigger as well. We have very small type positions right now. We'll go a little big as well. So Nykaa, I'll just give you an example. Nykaa has 71 lakh annual transacting customers. These customers will keep increasing. So how many users you have today, how many users they'll have in next 3-4 years. In my humble opinion, this 71 lakh will go to 1.5 to 2 crore users. Now, these users typically buy makeup 4 times a year. And every time they are buying makeup, this person makes, so it's all about habits. Valuation is created on habits. If, example, HUL has revenues of 50,000 crores and there are 100 crore Indians who are using HUL. That means 50,000 crore divided by 100 crore, that comes to 500 rupees. That is the revenue that every Indian pays to HUL. On HUL, 17% is the PAT margin of HUL. That means every Indian broadly gives 80-90 rupees to HUL. In Nykaa's case, it's the exact same business model where you have customers, but the customers here are not giving you 70-80 rupees profit. The old customers are giving you 2,000-3,000 rupees profits every year, which is used to acquire new customers, which is your CAC, which is your cost of acquisition of a customer. So let's take an example. If Amazon spends 1,000 rupees on acquiring me, okay, he does digital ads and does whatever, he acquires me at 1,000 rupees. For next, and every month I buy 500 rupees goods on Amazon. 20% is Amazon's profit margin on that. That means Amazon makes 100 rupees from me every month. Amazon makes 1,200 rupees again back from me. But for next 20-30 years, I will keep spending on Amazon. And if my income goes higher, I'll spend more on Amazon. That is how these business models are made. How many users you have, the existing users, what is the unit economics? Are the existing users giving cash flows? And that cash flow is used to acquire new users. And at some point of time, your existing users, the day the growth of new users goes down, right? New user growth and your old users are very large. That's where you get a complete J-curve. And that is how profitability is determined. So it is not profit pools of today. It is profit pools of tomorrow. In the case of Zomato, Zomato is it's not like only India has Zomato. DoorDash is there, Uber Eats is there. Uber Eats does $30 billion rupees of revenues on mobility. Does $30 billion of revenues on mobility, which is your taxis and everything. And Uber is the second player in every country. Go to China, go to UK, you go to US. After everything, Uber is the second player, like with Ola in India or anywhere you go. The same company has now already reached, he reached 30 billion in mobility. He's already reached $40 billion in Uber Eats. Now, Uber Eats is not a market leader. It is only in US also, Uber Eats is like 23% market share. 56% market share is with DoorDash. DoorDash, who's like the Zomato of GMV. Last year, the GMV of Zomato was $1.5 billion. Zomato GMV was 11,000 crores. Meituan in China, if you look at the GMV, it's closer to $65 billion. So home delivery business, Meituan is doing 1,300 crore orders every year. That is closer to 300 crore orders every quarter. That's closer to 100 crore orders every month. If globally things are happening, it will happen in India also. So Zomato will scale up faster than what people think. How he turns profitable is where his metro. So if you look at what he's saying, in his metro cities is where he's making money, but he's expanding into newer cities, and that's where he loses money. So let's take an example of. So I'm just doing this for explanation purpose. Please don't buy because I'm telling you to explaining you. So assuming Zomato is in 15 crore orders Zomato did this quarter, and Zomato is at 5,500 crore GMV. That is the GMV what Zomato did. Zomato at end of the year will do at least 23,000 crores of GMV. Okay. Right? 5,500 crores is one quarter. So 23,000 crores will be the GMV at end of 2022 this year. Zomato first quarter lost 170 crores. This quarter lost 300 crores. In my opinion, Zomato will lose 1,000 crore rupees total in first this year. Now in 1,000 crores, he's built a 23,000 crore franchisee, right? Now this is bigger than Nestle. Total sales of Nestle is 12,000 crores, right? 1,000 crore mein you built now. Even if next year the total cash that Zomato has is 16,000 crores, right? Cash on books with Zomato has is 16. So there's no problem that it will go bankrupt. Interest will be 5% of that, which is 800 crores, right? Now, next year, if Zomato basically grows at 60, 70, 80%, which I believe it will, it goes to near 40,000 crores of GMV, right? 40,000 crores GMV. And if it loses 1,000 crores, not a problem. It is losing 2% of GMV. If 2% of, right? If you are making 40,000 crores of GMV and you lose 2% of GMV, there are many places in which you can get the GMV back. You can have Zomato Pro, you can have Hyperpure, where you become end-to-end of a restaurant. So these companies, you look at what they are doing till the time they're scaling up, and these are risky bets. So it's not like we go 10-15% of our portfolio. These bets in total are 6% of our portfolio. So, but we will learn this game, because the next 500 out of the next 500 IPOs, 350 will be tech companies. We want to have an edge here. We want to learn this game. If my alpha is 10.5%, I can go to my investors and say, you know what, I lost 1% alpha for you. And my alpha at the end of the year is 9.5%. I know my investors. They will not say that, oh no, you lost this 1% alpha. Because if I don't learn, then I will not win in the long term. And it's all about long-term winning for us. So coming back to Zomato. So where will be the terminal of Zomato is what we have to see. It's a proven business model. Globally is doing well. DoorDash is profitable. they will move to grocery. They will have to move to grocery. DoorDash made an acquisition in grocery. So slowly they'll make the same thing. They'll acquire Grofers. This first 6 months, Zomato market share has gone now near 57-58% when you compare it to Swiggy. So we have to look at things every quarter and think what the next 3 years will be. For now, my thinking is there'll be hyper growth. Wrong, right, how it goes, and we also have to look at price action, to be honest, how the price is reacting. Because if the stock is growing fast, it has to be supported by stock price as well. And if the stock price is growing in line with the growth, that is where money would be made. So we'll have to learn this thing. We are in learning stage. We are at discovery stage ourselves here. And once we have a very proven philosophy, but we understand the game. It's not like if we have taken this 6% allocation, I should tell my investors and who are not my potential investors, we have worked extremely hard, not for the 94% of our portfolio, but for this 6% part of the portfolio, because this 6% part someday will be 40% part of a portfolio. We are just sowing seeds. Now, we don't know which one will become a forest or which one will become a tree, but the seeds need to be sowed today to learn what is happening in technology, because customers are moving to technology. There is large value migration which is happening towards technology, and we want to learn and be in this game. So sorry, I went a little off topic also, Kamalji, but that's broadly that was like the more important thing. Bajaj Finance is also pivoting to technology. So in next 3 years, if Bajaj Finance doesn't, you don't say that Bajaj Finance is a technology company, I'll be very, very, very sad. Because Rajiv Jain is a hyper executor. And the game is 15 December is where they go live on their new platforms. That's where the street is excited about. They will not get it right on day one. It's not possible in tech business you get it right on day one. But in next 1 year, you will see Bajaj Finance as more of a technology company. Asian Paint should do well because of the real estate story, and it keeps your lower beta lower. So that's why it's a decent bet. But yeah, it will compound it will do 20% from here also. This is what I believe, because crude prices have come down. And yet I'm sure they've taken a 13-14% price hike in 1 quarter. That's the highest price hike. So automatically, assuming volumes remain same of last quarter, Asian Paint will do like 8,500 crore revenues. 7,500 crores was revenue last quarter, plus some volume growth because of Diwali and there are price hikes. So next 1 to 3 quarters should be decent for Asian Paint, but it's a good long-term bet. Amit Single, the new CEO, he's added distribution. So anyone who saw this con call of Asian Paint, in last 2 years, they have doubled their distributors from 80,000 to 1.6 lakh. I have not seen a company of this size being as aggressive. So that's a decent bet. It will compound capital decently for you. No problem in that.
Right, Amit, quite convincing answers. One last question, which often is asked by investors regarding some of these high, price to perfection kind of businesses like Asian Paints. So though I agree with most of what you have said, but the high valuation of stocks like Asian Paints, Avenue Supermart, doesn't this scare you? Because valuations theoretically are very, very high.
So let's take an example like Asian Paint will do an EPS of 60 rupees in FY24, right? And the markets are pricing it at 50 times FY24. If your ROC of Asian Paint is, let's say, 41%. Now this guy is speaking about beautiful homes. So your industry growth is 12%, which is your paint industry growth. And then if your beautiful homes can add 4-5% to your growth, which is not a big deal for Asian Paint. So that is the whole thing. That till the time it's growing at. It's last year we didn't have Asian Paint till last quarter. We've added Asian Paint this quarter, to be honest. So we never, because we had larger outperformers. So we didn't get into Asian Paint, but this quarter we started being a little more defensive. You might be knowing, Kamalji, we've got very defensive on the portfolio, and that's why we added. We made a proven monopoly basket. Which is typically 60%. We made it closer to 67%, and that's where we added our Asian Paint. Our emerging monopolies are now 33%. So that is why we added Asian Paint. It gives me growth because I am very positive on building materials, to be honest. I'm very, very positive. So if you see, our largest bet is actually a building material stock, not Asian Paint. That is 3-4% of the portfolio. But the Delhi-based structural steel, that is our largest bet in the portfolio. That DMart and yeah. So DMart will do well. Don't worry, because DMart will also see, DMart longevity is very large, Kamalji, and this is not normalized profits. What you are seeing at 1,200 crores profit, this will go to 3,000 crore profits, and then you have to see after 2023 also which are the guys who will grow at 25%. DMart will keep growing at 25%, and once you get those kind of bets, you don't leave them. I'll tell you when to exit it. So we keep thinking when will be a time and we'll exit, because we've been first day first show, right? Yeah. So it's been a very long time since our inception of the PMS. So it's been a long time that we hold. So the day we believe that longevity of the growth becomes lesser, or any other player can become lower cost than DMart, right? We will start cutting off. The day anyone can crack this low cost model. Because till the time you can't crack, look at Costco. Look at the chart. Go on Google. Look at the chart of Costco. When was the best time to sell Walmart? That was in 2005-6. Since then, it is not like it's not given return, but it's underperformed Costco. Because Costco created a model of memberships, which was even lower cost than DMart. So once you get a player who's lower cost, that is where you exit. Till the time you have 40-50 years of data, Kamalji, on grocery retail, that how grocery retail has evolved. If you think about it, retail is one place where largest wealth is created. Think QSR, retail, this is my favorite, building materials, tech, those are my favorite sectors, because that is where largest wealth is created. Look at, let's say, a chart of, sorry, I got a little confused here. I was trying to make a point on retail, but yes. So Costco, देखो ये retail में बहुत पैसा बनेगा, sir. Look at, sorry, I got it. Walmart sales are 500 crores. Amazon sales are also 500 billion dollars. Walmart sales are 500 billion dollars. Amazon sales, this is the first quarter where Amazon did more sales than Walmart. Retail as a business is intrinsically hyperscaler. Amazon is nothing but retail, right? It is just retail, but it doesn't have stores. It just delivers it to you, right? Retail intrinsically as a business has a very QSR. Look at how much wealth. Look at, for people who don't track global markets, look at Dow Jones Bar and Restaurant Index. It has given higher returns than Nasdaq also for last 35 years, right? Because the unorganized pie is so large, and today in India, 4 lakh crores is our QSR market. The largest player is 4,000 crores, which is your Domino's Pizza, right? He's got 7 crore app downloads. There is no way anyone, and his ROCs are 60-65%. Why will this company not grow at 15, 20, 25%? And globally, just look at how QSR has grown, because unorganized pie is so large, right? There will be a Shiv Sagar in your area or whatever, but except that Shetty Udupi restaurant, you need those, Domino's. And my kids, I don't have, but my kids, I'm sure, Kamalji's kids and everyone's kids are going to have Domino's, Burger King. We just have one QSR name, but that is where the biggest wealth will be made in the QSR space. It's a very large opportunity, Kamalji. Next decade is just the games getting started in these kind of companies.
Right, Amit. So, I will just take this last question, and we have stressed it beyond 1 hour because, your talk has been very insightful, and it is interesting to, keep watching. And I can tell you, there was a 240 as a unique audience, which was watching this. And now, as of right now, also there are around 200 people who are logged in. And I would also want to give this disclaimer to everyone who has watched this so far and may want to kind of watch it again, that whatever this discussion we are doing, whatever stocks we have discussed, it is nothing to do with any advice. Please do not construe this as an advice. This is just a learning oriented discussion. And because, whenever anybody wants to invest in a portfolio management service, it is investors' right to understand each and every company within that, each and every stock within that. And that is where, there is nobody better than the founder, than the fund manager himself. And that is the intent here. So this is the last question to you, Amit. We are talking about the highest earning possibilities over next 5 years, over next 1 decade. Now, I would also want to understand from you, in last decade, or maybe, the first decade of this this century, which is 2000 to 2010, we saw 3 sectors, which kind of contributed a lot, and which are also kind of important sectors for India. One is infrastructure, second is power, and third is telecom, right? Infrastructure, power, and telecom. Now, in your entire discussion, you have not talked about these three sectors. And I see when, our Prime Minister, Mr. Modi or Modi ji, who has been kind of very vocal about Atmanirbhar Bharat. He has been kind of, trying to again follow to do something to do with, inward thinking. So how, given this inward thinking, the if we have to actually achieve, a 3 trillion to 7 trillion kind of an economy, these are the core India sectors. Won't these sectors also contribute to this growth?
See, I'll tell you, in telecom, you already have 100 crore users. So you cannot say that everyone will have 2 SIM cards, right? The only growth, the ARPU today is 150 rupees broadly for all telecom players except Vodafone Idea. And you've already disrupted the industry from 16 players has gone to 3 players, 2.5 players. But you know that maximum if Reliance goes from 42 crore users, go to 50 crore users, he'll have to have an ARPU rise and all that. But that's not the big profit trigger, right? You at one point, the markets are already discounting that very high, like a 200, 220 ARPU. So that is a good play. People, Bharti will become defensive. Reliance will do okay, but like I would rather bet on Reliance Retail. If given a choice of Reliance Jio and Reliance Retail, I'll buy on Reliance Retail. Or if they were demerged. The second question is about power. The problem is, Kamalji, if power companies start making very high ROEs, okay, let's say Tata Power starts making ROEs, your chief minister will go outside outside Tata Power's office and say that, you know what, if Tata Power makes 25% ROCEs, okay, you'll have a lot of politicians who will just say that, I want free electricity and all that, because it's a very utilities are typically very highly not only regulated but always on the political. So that's why no one actually made money in education also in India, right? The business is a very recurring business. Everything's perfect, but you've got a lot of other things that you have to focus on. So it's about reinvesting. So these businesses will not reinvest capital at 30-35% ROIC or 25% ROIC. These businesses will reinvest capital at 12 to 15% ROIC. So when I have choices of reinvesting capital at 30% ROIC or 25% ROIC, I don't. That's why we don't invest in the low ROIC businesses. So that's the only reason. And infrastructure, it's like receivables go down. It's not like we're not invested in infrastructure. We've been slapped by markets before, but we've learned our lessons. But we should not do in B2G. If you don't do B2G, you'll still be very rich. Don't worry. Those are very cyclicals. It goes from 20 rupees to 100 rupees, then it goes down to 30, 40 rupees. It's very difficult to time those cycles. My investors want low beta. It's not about highest returns only. It's all about consistently doing well. And these guys are not consistent at all. See, who's the largest infrastructure player in UK? Who's the largest infrastructure player in US? Who's the largest infrastructure player in Thailand or any other country, Australia? None, because that doesn't exist. They don't have a longevity more than 10 years. In India, except L&T, who's actually more capital goods than infrastructure, right? There is no one who's been able to survive. Today, I can guarantee you, think about it. L&T was an infrastructure company. I guarantee you in some time, the market cap of LTI and LTTS and Mindtree, which is all three are L&T companies, will be larger than L&T combined. Because, see, this guy has invested lakhs and lakhs of crore rupees in your infrastructure businesses, right? He's invested 700 crores in LTTS, and 300 crores in LTI. 1,000 rupees he's invested in these both players. Mindtree, I think he invested at 7, 8, 9,000 crores market cap. He bought 50%. He's invested 4,500. These three players will become bigger than L&T because they are automatically generating cash flows which are paying off as dividend, reinvesting into. So you'll just see where this goes. Like a government company like what L&T does and what the technology, you'll see that how capital is getting made. So that is my understanding, and I'm just giving you an example. That's why we want to buy, and we don't have LTTS or LTI in the portfolio, but I'll just give you an example between a government stock and That's the seed that I want to sow, the technology seed, not the government 12% ROIC seed.
Absolutely, convinced, Amit. So this has been really very insightful session. Thank you everyone for joining us. And I have shared on the chat book a call link. You are most welcome to this insightful experience. For your all wealth related goals. We do really, 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 very good knowledgeable interactions and consulting for all our clients. And this is just one of the, I would say, webinars amongst, I would say, 500 webinars that we would have done, more than 500 webinars over last 3 years of our journey. And like Amit is one of the fund managers kind of who we like. There are few more which are kind of the ones that we have selected for all our clients. And thank you so much, Amit, once again for sparing your time on Saturday. You have actually answered most of the questions and kind of you have reinforced our confidence. And it has always been a kind of a, I would say, new learning, and I look forward to that on ongoing basis, because we are all knowledge seekers and we are living in knowledge era. Thank you very much once again.
Thank you, Kamalji. Thank you everyone for attending this. Have a great weekend. Bye-bye. Bye, Kamalji. Thank you so much for hosting this. You guys rock as always. Bye.